Okay. So please, where did we stop in our previous class? Where did we stop in our previous class? Okay, I give assignments. Olamide, are you in this class?
Yes, sir.
Well done, well done, well done.
Thank you, sir.
Really great. I think your presentation, right? It makes sense. It makes sense. Well done. Well done. Now
Thank you,
you got,
sir.
yeah, you got it correctly.
Wow.
Well done. I think I saw someone's coming. Let me check. Uh, minutes. I need to check this person's. So out of 2,000, I think 1,000 plus, just two persons did their assignments. Interesting, interesting, and that is a very good one. Oh, this is a very good one. Yep, yep. Oh, I need to check. Okay, while I'm checking for the while I'm checking the suggested solution. So please, do we have anyone that have question? If you have question for me, quickly unmute your mic.
Good evening, sir. Hello, sir. Good evening.
I'm with you. Good evening.
Sir, I was thinking our lectures are Tuesdays, Wednesdays, and Saturdays.
But did you check the bottom of the timetable? Did you check
The
it?
bo-
Yes, that the timetable is subject to change.
Okay, I didn't know that they changed it too. I
No,
didn't know.
madam, you will see more of this by February. You will see more of classes like this by February. Let me quickly prepare every one of you. Let me quickly prepare your mind. We see more of this. And that is the reason why I mentioned it in the last class that we will have class on Monday. I mentioned it, right? And I think Christy sent that message at I think 12 a.m. this morning. Sent it this morning that we have class 12 a.m. So you will see more of this, most especially SFM, right? Most especially SFM. Any other question?
The video cannot download for me.
Yes. Which one of them?
The ones on the YouTube,
Everything.
they can't. They say download not available.
When did you try to download it first? When did you
You
try to
said, you
download it?
said after 24 hours, you should give it more than 24
Yes.
hours before you can. It did
Yes.
not download. Even the first day on did not download for me. So I
Oh,
have to use my data to watch.
apologies. I have to go back and check what could have went wrong. Actually, I'm not aware of that. But what I saw, the last message I saw was like, I have to give it like 24 hours. But can someone try to check, please? Please, I need someone to confirm that as well so that we can rectify this issue, please. Sedeko. Olamide, please, can you confirm that?
Yes, I'm doing that.
Okay, that's fine. Thank you.
Sir, it is downloading.
Okay, okay. Angela.
Yes, I can download it.
Okay,
So,
Angela, please, maybe you have
yeah.
to check it again. That could be your, I don't know. Maybe you check it again, please.
Okay.
Yeah. So, thank you. I think this second person's own is also okay. I think the person did very well. The presentation makes sense. The presentation makes sense. Makes sense. Who is that? Who is the person? I need to check this person's name. Okay, Jenny. Okay, Jenny. Okay. Okay. So we'll be looking at question 4. I gave assignments, just 2 persons submit. It makes sense, right? Makes sense. So we'll be looking at question 4. I think okay, this is our 4th diet, right? I think the second diet, one of the question on cost of capital came out as 20 marks question. I think this is the question. Yes, this is it. And I think I gave their question as an assignment, and just few attempted the questions, which I corrected them that, oh, you have to do it this way, you have to do it this way, you have to do it like this. And it came out as 20 marks question, luckily. You see, the purpose of assignment is not to just like, oh, we just give assignments to just be there. It's to test knowledge, whether you understand that topic. However, I don't just bring any assignment, any questions. All my questions are not just like, all the questions are not just like, oh, maybe I just see maybe simple questions. I wanted to like quickly solve it so that I move on. No, I don't do that. I make sure the questions are examinable, are technical and examinable questions. I check ACCA's CIMA where students lack understanding. All those questions, I will extract them out, because that is what I can want. Like, they usually say that kind of question whereby when you see it, you will look at it that it is very simple. But it is when you start the question, you will know that this is a technical question. You have to apply the principle, right? You have to do what? You have to apply the principle. And today, now, just 2%, right? It's a very good one. This is a very good one. Okay. Now, question 4. This question is adopted from Ican study pack. Ican pass question. I think one of the diets, and you may check the examiner comments that the performance was very poor. It was very low. I think about low percentage thereabouts. Do you know why? Because of the question. When you look at it, when you see it, you're like, this is cost of capital. It's simple now. Is it not market value weighted average cost of capital? But there are some technicality. There are some things you need to unlock. If you don't unlock it, you will not get what the examiner says you should do. And that is the reason why you see some students will say, oh, I did it very well now. Yes, it's cost of capital. I've solved it before. I've done this before. It is not usually like that too. It is when the examiner say A, you do A. It is not that when examiner say A, you do B. You will not be, mark will not be awarded for that. Right? So please, I like the numbers of participants as well. 28 makes sense. So pay attention to my explanation on this is another aspect where question can come under cost of capital, where you can see question under what cost of capital. This will be the first worst case scenario. The second question we will solve will be the second worst case scenario questions. All right. So then we close the chapter of one part of cost of capital. We'll move to the second part, which is what the project specific cost of capital. So please make sure you check the groups, the SFM group, right? If there is any additional classes, you will see more of this by February. Most likely you'll be having SFM 4 times in a week or 3 times to 4 times in a week. Yes. Yes. So please make sure you follow the classes. Very important. Now, please, we will read question 4. Question 4. Can someone read? Okay. Now, required, calculate the market value after tax weighted average cost of capital of JP, explaining clearly any assumption you made, meaning that we should determine the weighted average cost of capital, right, of JP, and we should do what? We should explain any assumption, right? Any assumption. We should explain any assumption. B, discuss why market value weighted average cost of capital is preferred to what? Is preferred to book value weighted average cost of capital when making an investment decision. When what? When making an investment decision. C, discuss how the capital asset pricing model can be used to calculate a project specific cost of capital for JP, referring in your discussion to the key concept of systematic. I've explained this in our previous class, but this is like a bonus marks. When we get to project specific cost of capital, we still talk about systematic risk, business risk, and the financial risk. When we move to portfolio theory, we still talk about the business risk, the financial risk, and systematic risk, right? So the next question, okay, so now we look at this question now. So the first required is to determine after tax weighted cost of capital of JP, right? When we want to determine the after tax, what are the steps, class? To determine the weighted average cost of capital, what are the steps? What are the steps, class? Am I the only one in this class?
No, sir.
So what are the steps? Okay.
Hello, sir.
Okay, Angel.
Identify the sources of.
Angela, sorry. Angela.
Sir.
Yeah,
I'm
I'm
speaking.
with you. Yeah, I'm
And
with
I
you. Go
said,
ahead.
first of all, identify the sources of fund for the company. When you
Okay.
identify, then you calculate the cost of capital, both equity and debt. Now you
Okay.
determine the total market value of all the sources, that is equity and debt. After
Okay.
that, you now calculate the WACC by creating a table that
Okay.
contains
That's
the
fine.
item, the market
Okay.
value, the cost, and the hash totals.
Total. Okay.
At
That's
the
fine.
end, we now calculate the WACC, hash total over total market value. It will give us the WACC.
Wow. Okay. That makes sense, right? That's a very good one. I like that. Right. Well done. So, and that is that. It's as simple as ABC, right? Now, the directors of Jola PLC, an Abuja-based entertainment company, are currently considering the appropriate cost of capital to use in appraising capital investments. Class, please give me apologies. Please give me 5 minutes. I need to set up a class now. 5 minutes, please. 5 minutes. Thank you. Okay, 4 minutes. Yeah, 4 minutes. Thank you. Hello.
Yes, sir.
Okay, okay. Apologies, please. Apologies, my sister. Apologies for that. Right. Apologies. So, are we still together, please? Are we still together? So, the required of this question says that we should do what? Okay, thank you, everyone. The required of the question says that we should determine the market value after tax weighted average cost of capital, right? Then, at the beginning, the director of Jolayemi PLC, an Abuja-based entertainment, an Abuja-based entertainment company, are currently considering the appropriate cost of capital to use in appraising capital investments. Now, it is the policy of the company to assess the financial viability of capital projects using the MPV criteria, right? Now, when we get to investment appraisal, you will see that we should not forget that under the function of a financial manager, one of the function is the financing function. When you have identified the source of the finance, when you have actually what is it called, see a project that is actually viable, then you need to identify the sources of finance. Now they are now looking at which discount rates are they going to use to discount the projects, right? Now, and you have been provided with the following financial information of the company most recent statement of financial position. Class, what do we have here? We have equity. So now, class, what are the sources of finance from here? What are the sources of finance? Class, what are the sources of finance?
You can see equity. That is
Equity.
the convertible bond, the preference shares.
Preference shares. Okay. What about reserves? Reserves should be part of sources of finance now, right? Angela.
No, sir.
No, sir.
No, sir.
Okay, Favor. Okay. That's fine. Because because your reserve, what make up your reserve? Reserve is not part of, because you have it already. It will not cost you anything. Is that not so? You have it
Yes,
already.
sir.
Is that not so? So it will not cost you. So reserve is not part of the sources of finance. Right. So class. So these are the financial information given to you. Like I said in the previous class, this is equity finance. Right. Now you will now go back, you will check the bottom of the financial information. When you check the bottom of the financial information, you will see information about each of the sources of finance. Each of them, you will see information about each of the sources of finance. All you just need to do is to just come and match the sources of finance with the notes given to you. Now, like this question now, you can see that JP has an equity beta of 1.2 and the S dividend market value of the company equity is 1 billion. Can you see that this is talking about the equity? JP has an equity beta of 1.2 and the SDIV, right? SDIV market value of the company's equity is 1 billion. Something should just come to your mind here, that this is not usual, right? What happened here? We'll get there. What happened, class? What happened in this place?
Total.
Thank you. That shows that you guys are following, honestly. Yes. You can see that is one of the trap. Now, it is not common. The examiner gave us the market value as div. The total market value is given to us for equity. But the one of per one, the market value as div per one is not given to us. So which means that we have to determine that, right? Right? If we need it. Now, the S interest market value. Now, the first one is for equity. And this equity is the first sources of finance. Now, the second sources of finance is convertible. Now, the next paragraph, right? The next story is that the S interest market value of the convertible bond is 168 million. Class. The market value S interest again for the convertible bond is given as a total. Is given in total. Is given in what? Is given in what? Is given in total, which is not usual, right? And the SDIV market value of preference share is given as what? 50 million. You can see that the market value SDIV of each of the sources of finance has been given as the what? As the total. They've given us total market value of each of the what? Of the sources of finance. Now, the convertible bonds. The convertible bonds of JP have a conversion ratio of 19. Ordinary what? Ordinary current, ordinary share, ordinary current, ordinary share price of what? Of JP class. They've given us the next sources of finance is the convertible. Okay, they've talked about convertible. Now, they are telling us here that the examiner now says that, okay, the convertible bond, so it has a conversion ratio of 19 ordinary what? 19 ordinary share per what? Per bond. That is the conversion what? The conversion ratio. Now, the conversion date and the redemption date are both on the same date in 5 years time. They just tell us that the conversion date and the redemption date is 5 years. Now, the current ordinary share price of JP is expected to increase by how many percent? 4% per year. Something should just be coming to your mind from the formula. You can see that the convertible value is not given to us, but the examiner is giving us the ingredients that we will need to determine the convertible value. The conversion ratio is given, and the ordinary share price, which is the growth rate of 4%. Now, the next one is the equity risk premium is 5%, and the risk-free is 4%. JP pays profit tax at an annual rate of 30%. Class, you can see that the sources of finance, the first sources of finance is equity. Is it dividend valuation or capital asset pricing model? You can see that in this question, the question did not say using the capital asset pricing model, but you, as a professional, you can see that the only ingredient we have under the equity is CAPM. Is that also? Is what? Is CAPM. So that means that when we want to determine our cost of equity, we use CAPM because no dividend with goods. They didn't tell us that we should use Gordons. If it is Gordons, the examiner will state it clearly that you should use Gordons. But if it is other model, maybe dividend valuation or capital asset pricing model, maybe dividend valuation without goods, and what is it called? And capital asset price, you will be the one to, like, from the question, you will know, oh, is the dividend growing? Oh, if it is growing, is it extrapolation or Gordons? It means, oh, extrapolation is also known as geometric mean. maybe you are given a series of what? A series of dividend. But here we're given the what? The CAPM ingredients. So we need to determine first, let's pick it one after the other, right? The sources of finance. Class, are we still together? Are we still together,
Yes, sir.
please?
Yes,
Yes,
sir.
sir.
Okay, that's fine. That's fine. Suggested solution, JP. Suggested solution, JP, sources of finance. The first sources of finance is our equity, or we can say ordinary shares, right? Which we are to use CAPM. Let me state it here, CAPM, right? KE, risk-free, right? Plus equity beta. We have what? Market return minus what, class? Minus what?
Risk free.
Minus risk-free. Class, don't forget that if risk premium is given, is risk premium given to us in this question? I guess, okay. I guess no. Okay, risk premium is given to us. You can see that we will not use this first formula, formula 1, because we have risk premium. We have what? Risk premium of 5%. Risk premium is given to us in this what? In this question. We have what? Risk premium of what? Risk premium of 5%. Right? So we change the formula to have, we have risk premium here, RP, the second formula. So you need to give me figure. KE equals to, what is the risk free from the question, class? If you have your question, check question 4. If you have the material, check question 4. Okay. What is the risk free?
4%.
4 plus, what is the equity beta?
1.2.
1.2, right? 1.2. 1.2. So what is the risk premium?
5.
5%.
The risk premium is 5, which is 5%, right?
Yes,
So
sir.
I usually ignore the percentage so that to save time, right? So at the end, you still need to just leave it like that. So what do we avoid is the cost of equity,
10.
10%.
10%,
Yes,
right?
sir.
The cost of equity is 10%. Why do we have to use CAPM? Because we were given the ingredients for CAPM. There's no dividend valuation model, whether with goods or what, or without goods. Class, what is the next step? The next step for us is to do what? Is to determine the total what? The total market value. Total market value is to determine the what? Total market value. Now, from the question, we can see that the market value is given to us already, right? The market value is given to us already. And the SDIV market value of the company equity, class, is 1 billion, right? The market value is given to us as what? As 1 billion. Angela, you know the rule, right? I'm seeing your hand. What happened? Am I safe? Okay, I think she left. Angela, are you still there? Okay. Okay. So the total market value is 1 billion is given to us in the question. So that means that we don't need to do what? We don't need to calculate the is this now? What happened? We know the rule now. Okay. Oh. Now, the total market value is given to us already as what? As 1 billion. So we don't need to do what? Calculate the total market value. So thereafter, we need to move to the next sources of finance. The next sources of finance. The next sources of finance. What is the next sources of from the capital structure, from the financial information? What is the next sources of finance, class?
Convertible bond.
Convertible bond.
Convertible bond.
Convertible bond. So my prayer is that this question should come. And if you want to come, if the question will come, maybe 20 marks or 15 marks questions, right? And those who are not in class, and we'll go back to the YouTube, I'll actually check. So the convertible bond, and this is where we have to work, all of us, like we have to work together, right? The convertible what? The convertible bond. The question is, we need to go back to the what? To the story, to the all those English, right? We're given a convertible bond. The 7% here is the interest rates. This is the nominal, and this is the value. Now, we have the S interest market value of the convertible bond is 168 million. They've given us the value of a convertible bond. We don't have issue with that. Is that not so? We don't have issue with what the value, the total market value of what? Of convertible. Class. We should not forget whether it is convertible or redeemable. You use what to determine the internal to determine the cost? What are we going to use to determine the costs?
IRR.
Internal rate of return. Whether it is convertible or redeemable. But in this question, we are given what we are given is what? A convertible bonds. Now, we're given a convertible bond. How do we determine the cost of a convertible bond? We will use internal rate of return, right? Now, my next question is, what are the ingredients? What are the ingredients, class? Market value? What are the ingredients? I'm waiting to
Interest
market value,
and
S
tax.
interest.
Yeah.
S interest per bond, per one. Let's pick it one after the other first. Now, we need the market value. You can mute your mic. Abiodun, thank you. We need the market value as interest per bond, per one. But do you know what the examiner did? The examiner gave us the total market value, of the convertible bond. Then it left to us to do what? To calculate the what? The market value as interest per bond. Class, if you want to calculate the S interest per bond, what are we going to do? You can tell us. Since we have 168, so we need to get 168 million. We need to get per bond. What are we going to do to calculate the market value as interest per one? Anyone?
You divide it by the nominal value.
No. If you divide it by the nominal value, it will give us the numbers of bonds. Is that not so? It will give you the numbers of bonds. But we want to get just like 3 naira per share. We want to get 4 naira per bond. We're given the total of 168 million. Right? We want to get per bond. Is that not so? What are we going to do? Anyone?
So, sorry, it means we are going to divide the value of the bond on the financial statement by the nominal value to get the total number of convertible bond.
bonds.
So we then divide the 168 million naira by the value.
Thank you. Thank you. It's as simple as that. Yes, it's as simple as that. And that is what we will do. Right? What we will do is to get the numbers of bonds. Just like the way we normally do the shares. Favor, please, can you mute your mic? It's just like the way we normally do what is it called? Equity. The 160 divided by 100 will give you the numbers of shares. If you divide it by the total market value, we give you per one. Is that not so, class? We give you what? Per one. We will do the same thing with what? The convertible what? The convertible bond. The first thing we need to do, let's get the numbers of convertible bonds or numbers of bonds. Numbers of bonds is equals to value of, let me write it out in case you want to go back. Value of convertible bonds divided by the nominal value of the convertible bonds. So we need to check what is the value of convertible bonds. 160 million divided by 100. 160 divided by 100. We have 160 million bonds, right? 160 million bonds. You know, this is how to break question down. If you want to earn more marks, you have to show us, you have to show the examiner how you arrive at each of your solution, because they mark what? They mark steps, right? Not your final answer. How you arrive at this figure, they want to know. Now, you have what? 160 million bonds.
1.60.
1.6 million bonds. Sir.
Oh, sorry. It's even 100 naira. Sorry. Oh, sorry. 1.6. Thank you. 1.6 million bonds. Thank you. Now, we've gotten this. So therefore, our market value as interest per bond is equals to total market value as interest, right, divided by numbers of bonds, divided by the what? The numbers of what? Numbers of bonds. So therefore equals to, what is the total market value as interest of the convertible bonds? What is the total market value? 168.
168.
168. Good. 168. 168 million divided by 1.6 million bonds. So what do we have?
105.
105.
It is not like that. So 105, just 105. 105, 105, 105
Bond.
per bond.
bond.
Thank you.
That's
Per
right.
bond. Right? Why I'm putting this is because when you see a question, so that you will understand that, okay, this is per bond, okay, this is total. So you know where to pick your ingredients, right? You know where to pick all those ingredients, so that you know that, oh, this is market value as interest per bond. Oh, this is different from total, right? Now, this will be year zero. We already know this, right? Year zero. Year zero. Right? Now, the next thing is what? Interest. Interest. If you check your convertible bonds, you will see the interest attached to it. Can you see 7%? Now, examiner can decide, there's another trick here that the examiner may actually use, right? Under cost of capital. You see that 7%, they may not even put it here for the financial for the financial information. They will come to this paragraph and say, oh, 7%. Then when you check this place, you'll start looking for interest rates on convertible. But when you check the notes, you will see that it is attached to it. The 7% is the interest rate on that particular bond. So we need to convert the 7% to Naira. So the nominal value is 100 to Naira. So 7, we can have 7 divided by 100 times the nominal value. You can agree with me that this will be 7 Naira. Now, the next question is for how many years? That will be the next question. Is that not so? That will be the next what? That will be the next question. Was it stated that the convertible bond is for
Yes.
this?
5
So,
years.
Yes, sir.
5 years. Where is the 5 years? So away.
At the fourth
In
line.
the fourth line.
Fourth
Okay.
line.
Okay. The convertible bonds. Okay. Thank you so much. Yeah. So the conversion date and the redemption date are both on the same date in 5 years, meaning that at the end of 5 years, whether it is convertible or redeemable, you will pay me my interest and principal, right? It is actually a convertible bond. Sorry, it is actually a convertible bond, not a redemption. That is a convertible bond. You convert it to shares, right? We should not forget that under the convertible, we have either they convert to shares or they redeem. This particular question is on convertible bond. Means that they want to actually if it is a redeemable bond, it would have been stated that this is a redeemable bond. In some question, if the examiner still want to test your knowledge, the question will give you both convertible and redeemable. And you should know that the higher of the two, I think I will look for one question on that. I think that will be in our intensive class, right? The higher of the two, that will give us the value of either convertible or redeemable. We'll get there, right? We'll get there. Now, if you look at this, is for how many years? It's for 5 years, meaning that you will pay interest from year 1 to what? From year 1 to 5, right? From year 1 to what? Year 1 to 5. That will be the interest. So the next one is the tax relief on the interest. See, the main problem of this question is the convertible bond. Any other part of the question is straightforward, right? All other parts are straightforward. Okay. So the interest, how many percent is the tax rate? How many percent, class? 30%.
30%.
30%. 30 over 100 times the interest rates. Class, what do we have? What is the tax relief?
2.1.
2.1 from year 1 to 5. Right? From year 1 to what? Year 1 to 5. That is the tax relief on the what? On the interest. Class. You have your market value S interest. We have the interest. And the numbers of years is 5 years. Now, what will be the last ingredient, class?
Redemption.
Convertible value. It will not be redemption because this is a convertible bond, not a redeemable bond. The last principal amount, right? It is called a principal. That is the convertible value, right? Because it is a what? A convertible bond. If it is a redeemable bond, right, it would have been a redemption. So we can have here convertible value. Now, you know, in the previous class, in the previous lecture, most times, examiner will say the convertible value is the nominal value, 100. Or the examiner will say, oh, the convertible value is at par. That is 100. But in this question, there's nothing like that. So that means that we have to determine the value of convertible. We need to unlock it, right? We need to do what? Unlock that. We need to determine the value of what? Of a convertible bond. Now, in some question in the previous, you will see that they will say, oh, redeemable value is at par, convertible value is at par, or the convertible value is the nominal value of 100 naira is given. You can see now that the convertible value is not given to us. Now, the question is, how do we determine convertible value? Who can help us? Who will help us out? Right? How do we determine the value of a convertible bond? Convertible value. Anyone?
Is the 105 that we got.
We use the convertible formula.
Okay. Now, Oluwatosin, tell us, which of the convertible formula are we going to use? Because we're given the conversion ratio. We're given the numbers of years, the growth rates. So which of them? Give us the formula. Just tell us the formula.
CV.
Okay.
Is equals to EV open bracket 1 plus G raised power n times R.
Raised to power n times R. Okay.
Yes.
Oh yeah, define it for us. Okay, no, don't worry. You've already tell us the formula, right? Okay, makes sense. Well done, Oluwatosin. Well done. So we need someone to define those formulas. We need to know. I don't know what is V. I don't know what is a G. Otumba, right? Otumba Aziz.
Sir, that's what I wanted to say. He has already said what I wanted to say.
Tell us, like, break it down. Tell us what is G, what is VE, what is this. So we need to know.
Okay. So the G is the growth rate.
Okay.
Yes, and then the what's it called?
You forgot the formula, right? You need it. You need to remember.
Okay.
Please. You don't have to forget that formula. Very important. Very important. Well done. Well done.
Hello, sir.
Well done. Okay. Okikiola, don't worry. So that we can move, right? Thank you, Okikiola. Olamide. The two Olas,
Okay,
right?
sir.
All right. Let's move on. Don't worry.
Okay, sir.
Yeah.
Should I go ahead?
No. Don't worry. Let's move on. We are moving on.
Okay, sir.
Yeah. Thank you. So, if you want to determine let me break it down. Okay. How to determine the value of convertible bond. So this is the formula. VE. Oh, let me even copy this thing. VE. We already know this one. No? VE is the value. Let me bring it out again. Value of equity per share. G is equals to the growth rate. R is equals to conversion ratio. You can see that the question is straightforward, but where you need to work is just the part of convertible. Once you get it, we are good. Now, the numbers of years is equal to 5. Now, how do we determine? We need to determine the value of equity. Or we can say market value of equity per share class. The market value is not the total market value, is market value of equity per one. Let's say, for instance, if the total market value today, NGS today, if you check NGS, maybe JITCO, the total market value today, maybe let me don't use JITCO, let me just use ABC, maybe 100 naira or 100,000. That is the total market value as of today. But what will be the market value per share? When you divide the outstanding shares, if you check NGS, when you divide the total market value and the outstanding shares, it will give you the market value of equity per share, meaning that it may equate to what you have as a market price as of today. Right? So now, if you look at from this question now, you will see that the total market value of equity is 1 billion. But we don't need the total. We need the what? What do we need? We need per share class. So therefore, we divide it by the numbers of shares so that we can have the market value of equity per share. So 1 billion divided by what is the numbers of shares of equity? We need to go back. Class. What is the numbers of shares? What will be the numbers of shares, class?
200.
200. I don't understand 200. What if I'm just joining this class for the first time? And
200 million.
You want to teach me how to determine numbers of shares. It will be 200 million naira, right? Divided by the number of shares, right? And the numbers of divided by the nominal value, sorry. When you divide it by the nominal value, you will have the number of shares, class, right? So When you divide it, you have 200 million shares, right? 200 million shares. 200 million shares. Class, what do we have? When you divide this, what do we have? How many naira? If you divide it, what do you have?
5 naira
5 naira per what?
Per
per
share.
share.
5 naira per share. Now, the growth rate is given to us in this question. We need to go back and check. What is the growth rate given to us in this question?
4%.
4%.
Yes.
Good. The growth rate is 4%. What is the convertible ratio? Conversion ratio given to us in this question? 19, right? The conversion ratio is 19. They gave us all the ingredients. The conversion ratio is 19. And the numbers of shares, the numbers of years is 5 years. So therefore, the convertible value of a bond, you want to get your convertible value per bond, CV, VE. What is our VE? Our VE is 5 naira. The growth rate is 4%. The numbers of years is 5 years. All right. The conversion ratio is 19. So what do we have? What is the convertible value per bond? What is the convertible value per bond?
115.6.
115.58.
Okay. One what? Sorry.
115.6.
0.58.
115.6 naira per bond. Right? That is what we will have. Class. So therefore, we have complete ingredients. So we can have 115.6 per bond. If you observe something, I don't know if you observe anything here, you will see that all the ingredients that you will use to determine the internal rate of return is not value, is per. That is when you will know that no. Oh, you can see that the examiner gave us the, please, Okikiola, please mute your mic. Give us the total, but we don't need the total. We need per one, right? So please take notes. Take notes. Very important. So all our ingredients, we have all our ingredients, right? So internal rate of return, we can try 2. Our 2% will give us positive, right? So we can have items. Is it items? Yes. Items, cash flow, the DCF, then the PV, right? We'll have the PV. Year 0, the market value as interest. What is the market value as interest calculated? 105. Then the DCF will be 1 since it's year 0. We can have here 105. The next one is the interest rate. Oh, sorry. Year 1, 2. Year 1 to year 5. Interest. Right. What is the interest? 7. Right. The next one is year 1 to 5. The tax relief. Right. What is the tax relief? 2.1. The next one is the redemption, convertible value at the last year, convertible value. We have 115.6. So please, I will need the DCF. Please quickly use your annuity. I need figure.
4.71.
Okay. Come in. 12 points. I don't need to do 12. No.
4.71.
4.71. Okay, good. So what is the total? What is the total?
32.97.
32.97. Good. This should be in jackets. Oh, okay. So we also have 4.71. What do we have? When you multiply, what do you have?
9.89.
9 point what? Sorry.
9.89.
Okay, 9.89. So what is the discount factor? If you don't know how to calculate get annuity, you can check the previous lecture, right? So what do we have? DCF. What is the DCF for just year 5?
0.91.
0.91. What do we have?
105.196.
What do we have? Sorry.
105.196.
10 what? Can you be audible? I think I'm struggling to hear you.
105.
105.20.
105.20. Okay, thank you. Yeah. So what is the MPV? What is the MPV? The positive MPV, what do we have?
$23.28.
23.28. Right, 23.28. Right. So this is the positive MPV. So we'll try 10%. Right. So if we have 10%, we should have, what is the DCF? Your annuity from year 1 to 5. You can check annuity from year 1 to 5.
3.79.
3.79. When you multiply, what do you have? What do you have?
26.53.
26.53. So this is 3.79. What do we have here?
7.95.
7.96.
7.96.
Please, others should confirm the figure, please. So what is the DCF? Or just year 5?
0.6.
0.62.
0.62. Who is that? The person should meet you. Write down this. Noisy. Okay, please meet somebody. Thank you. So when you multiply, a minute. When you multiply,
71.67.
what do we have?
71.67.
71.67. So what is the negative MPV? What do we have? What is the MPV?
$14.76.
14.76.
Negative.
14.76 or 70.
76.
Okay, please confirm all the figures, right? Very, very important. So at the end of the class, so the lower rate is 2%, right? Then positive MPV 23.28, positive MPV 0.28, minus times minus is plus negative MPV. So we have higher rates, which is 10, minus lower rates 2. So the final figure, please. What is the cost of convertible bond? What will be the cost of convertible bond?
6.9%.
6.9%.
6.9%. Or 0.69, right? Is that so? Is it 0.69 or 0.069?
0.069.
0.069. Okay. So this is the cost. We don't need to calculate the market value. It's given to us already. Total market value is equals to, it's given to us. Let's check it out. Total market value to be 168 million. 168, right? 168 million. So we are done. So any other sources of finance? Oh, we still have preference shares. Okay. We have preference shares, right? So what is the formula for calculating costs? Preference shares. Right? What is the formula for calculating costs of preference shares? Class.
Preference shares dividend divided by
Equals to the current dividend for preference shares per share divided by the market value as div. Right? The market value as div. Okay. So let's check the paragraph. If they give us the current dividend for preference shares. Oh, they just gave us the SDIV market value of preference shares. You can see the Ican wants you to unlock, the examiner wants you to unlock the question. He just gave us the total market value for preference shares. Where is the current dividend for preference shares? So how do we determine the current dividend? Looking at the financial information, what is the current dividend? What is the current dividend for preference shares, class? What is the current dividend for preference shares? Looking at the financial statements.
5%.
No, I don't want it in percentage. I want it in naira.
4 naira.
4
So that's
naira again.
That's 5 naira.
5 naira.
5 naira.
Yeah.
Yes.
Right? Just like the way we did in the previous class. You see that normally the examiner is supposed to say, oh, the current value of the dividend is this. But it was not, it was silent, right? So what you need, don't stress yourself. Like that second method, you can just say, don't even stress yourself, just say, oh, 5%. 5 divided by 100. I actually use that second method to prove that 5%. Right? Now, you can see you have 5%. That would be 5 divided by 100. Multiply by what? The nominal value. We give you the current dividend per share. Right? So therefore, we can have the current dividend per share equals to 5%, 5 divided by 100 times 1 naira. You have 5 naira per share. So we move to the next one. The market value SDIV per share. Don't forget, in some literature, you will see it as market price, SDIV, or join, right? Or join. So now, in this question, we're given the what? The total, but we don't need the total. We say we don't need this total total market value. We don't need the total. What we need is per one. Is that not so? So we need to determine the numbers of shares for preference shares, which is 80 divided by what? 1. Is that not so? 80 divided by what? 1. We give you the number, we give us the numbers of shares for preference shares. So therefore, let me break it down, right? Okay. Numbers of shares, let me make it simple, equals to value of, I may not be doing this moving forward, right? Okay. Value of preference shares, right? Divided by the numbers of shares, divided by the nominal value, will give us the numbers of shares. So we can have 80 million divided by, what is the nominal value? What is the nominal value, class?
1 naira.
1 naira.
1 naira, okay. 1 naira. 1 naira. So this will be, naira cancel naira, you have 80 million shares, right? So for you to determine the market value SDIV, total, let me break it down. Let me make it simple. Total market value SDIV, right? SDIV divided by the numbers of shares equals to, what is the total market value for preference shares?
50 million naira.
50 million divided by 80 million shares. What do we have? What do we have? What is the market value as SD per share?
Is 0.625.
0.625
Yes.
per share. So if you have this, so the cost of preference shares will be current dividend per share, which is 5 naira, right? Divided by the market value SD per share, multiplied by 100, 625. We give us the costs of preference shares. What do we have?
Jesus, sir, sorry to come in without
What do we have?
notice.
No. I have to finish first now.
The 5 naira is five kobo, so that we don't get the answer wrong. That's why I'm pinning the district here.
You would have wait. Let's
We
finish.
start
We'll go
working
back
on it
to
because
it.
we're copying. Thank you. No problem.
Okay. So is this 5 naira? This current dividend is okay.
5 kobo.
This will be 0.5. So we can have 0.5. Thank you. Right. 5% should be 0.05.
0.05.
0.05, exactly.
0.05.
Yes, that's correct. Mhm.
So what is the cost of preference shares? What is the cost of preference shares?
0.08.
0.08. 0.08. 0.08, that is 8%. All right. So we don't need to calculate the total market value for preference shares. All right. It's given to us as 15 what? 60 million. Please, the person should mute his mic, please. All right. We have the 50 million, right? So we need to bring in our table. WACC. Right? WACC. Items. Total market value, costs of capital. Then we have hash total. Right? So what is the first sources of finance? Ordinary shares, which is CAPM. So what is the total market value, class? What is the total market value? Chinemere Miracle, share you are writing now, so you should give us the total market value. Abi?
Sorry, sir. I didn't look at that direction, so let me put that first before the 1 billion.
1 billion.
1 billion. Thank you, Joe. 1 billion, right? So let's put 1 billion. Okay. So what is the cost? What is the cost?
10%.
10%. Thank you. So what is the next sources of finance? Convertible. So what do we have? What is the value? What is the total market value of convertible? 168, right?
168 million. Yes, sir.
168. So what is the cost?
6.9%.
6.9%. 6.9%. We have just 3 sources of finance, and we spent about how many hours? So you can see, just imagine like exam condition. Just imagine, let's just imagine that maybe you are writing this for the first time, right? It will look somehow because you look at it that total, and it used to be like market value per day, then you get your IRR, you move, right? It is not as usual, right? And that is the reason why I normally see something that if you go and watch one short video on YouTube and you believe that is it not cost of capital? I don't finish and pay. It is not like that. So now these days, the way Ican set question is different from what they've been doing before, right? Good. It will, the YouTube video, the short YouTube video will just give you like overview, not an in-depth analysis of those questions under each of the topic. They will just give you like a surface. There are more to all those questions, so that you will not believe that yes, you've covered cost of capital, right? In our intensive class, we will still have a cost of capital that include bond. How do we solve it? Should, in case you have this, when you have bond is included in the cost of capital, right? I think it is in one of the questions there. I think question one of these questions, right? But we'll not do it, right? Maybe when we get to bond valuation, we'll come back. So the preference what? The preference what? The preference shares. Preference shares. They have this, right? What is the cost? That is 8%. So please, I need Ola, are you there? I need
Yes, sir.
the total, please. The total of this, then okay,
100
Ola, right?
million.
Okay. What is the total market value?
100 million.
100. This?
No. For Ashura. Okay. For that one. That one is 1 billion. 218 million.
1 billion. 2 what?
218 million.
218. Okay.
Yes.
218. Okay. What do we have here?
100 million.
100 million.
100 million. Right.
Yes, sir.
So what do we have here?
11 million 592,000.
11 million
592,000.
92,000. So what do we have here?
4 million.
4 million. Okay. So we have here, what is the total hash total?
115 million 592,000.
115 million 592,000. So therefore, WACC is equals to your hash total. The hash total $592 divided by 218 plus. What is the WACC?
9.5%.
9.5%.
Yes, sir.
So I think I'm done with this question. 9.5%. Can you see? 9.5%.
Total for that convertible bond is 11 million and 40, not 11,590
Okay, 11 million
and 40.
040.
No, it's 11 million 590.
What we have there is correct, sir.
11
It's
million
11
what?
million 592,000.
590.
It's correct.
592. Okay. Please
Yes,
check.
sir.
Yes.
Okay, that's fine. You can mute your mic. Okay. Yeah, we are good. So I think I'm done with this question. Okay. So question 4. I've explained this before. Okay. The B part of the question, class. You can agree with me that the book value, the book value is different from the market value. Class. Now, the book value, the weighted average book value is these figures here without the market value. What you have here for equity, what you have here for equity is the book value. What you have here as convertible is the book value. What you have here as a preference share is the total book value of that sources of finance. The difference is that the book value does not consider the time value of money or the present economic situation, because it is just the book. It's just like you are comparing historical and the fair value. One market, one is historical. So the same thing applicable here. The book value does not include the current value of that what sources of finance. It does not include what is it called? It does not include economic inputs. Why the market value include the what is it called? The economic what input, because it is based on what is happening in the market. Now, the book value cannot be used to appraise a project. If you use the book value, the market value, book value, weighted average, if you did not use the total market value, plus if you did not use the total market value and you use 200, 120, what will happen? It means that you will overvalue the project because it does not include the time value of money. Plus, it is not the best approach as an investment analyst or as a financial expert. You have a project, maybe a capital investment. It could be a capital investment, and you need to appraise the project. You don't appraise the project based on the book value, because you will overvalue the project. It does not reflect the economic situation. The book value is the best approach. The book value weighted average cost of capital has include the economic situation. For instance, a practical illustration, if you have a model, you build up a model to discount a capital investment project, maybe 2% as the book value. The project will be viable. Let me come from that angle. The project will be what? Will be viable. But when you use market value, you will discover that 2%, you will end up having 1.5%. You will end up having 5%, because it has reflect the true value. And the higher the NPV, the higher the percentage, the lower the NPV. And the lower the percentage, the higher the NPV. So if you have 2%, most likely the project will be viable. But if you have 5% that reflect the market value, most likely the project will not be viable. In a nutshell, is that the book value, the market value, book value, the book value weighted average cost of capital is different from the market value. The book value, what you see here in the financial information, the book value, it does not reflect the economic situation. And if you use it to appraise the project, it may likely give a positive NPV. While when you use market value, it will give a negative NPV, right? So therefore, the market value weighted average cost of capital should be used to value a business, to discount a capital investment project. And this is just 4 marks. So you have to come from different angle, the way you understand it. Okay, this is this, this is this, this is this, this is that. Class, who is against us in this class? Are we still together, please? Are we still together?
Yes, sir. Yes, sir.
Okay, that's fine. Okay, that's fine. I think that's I think okay. Today's class will be the end of one part of cost of capital. Assignments. Now this is the third one, right? Assignments. You can try your luck. Do it. Share your suggested solution in the general group. Let me see what you have. Question 3. Question 3. Question 3. I gave question 5. Just 2 persons submit, right? Makes sense. Makes sense. So question 2, question 5. If you know you've not done it, please go and do my assignment. So very important. And question 7. You see, this question 6. This question 6 include cost of capital that leads to bond valuation. We'll get there. You see, I will not bring question that will never be examinable. Like, that will not be examinable anywhere. When you see it, you will know that this is the kind of question. The question I can like to set questions that when you see it, before you know how to start, you spent like 2 hours. Right? You will spend like 2 hours, like, oh, how will I start this question? Is it not cost of capital? Is it not the usual cost of capital? Yes, it is. But we need to unlock some things. And when we get to bond valuation, you will get to know, to have more understanding of why we start from the cost of capital. Right? So I think we have to go. So in our next class, my class is on Wednesday, right? We'll move to the next, we are to the second part of cost of capital, which is project specific cost of capital. Class, grace does not work in isolation. Or you can't just sit and be convenient. Tell yourself, it's just like you are working in an organization. They give you, let me even include car. They give you car, they give you what again? They give you good office, AC. You receive AC in the morning. Then you are comfortable. Yes, you are comfortable there. It is not good to be too comfortable, right? Because anything can actually happen at any time. Now, likewise, this, you have to inconvenience for yourself. I have to inconvenience myself. I have a private class that I'm supposed to take. If I tell you how much I I collect for private class in SFM, just SFM, right? I may not even come to next gen and take any courses, like any classes again. I will just tell someone, okay, please come on, just take SFM, because it's enough for me. But I don't do that. I just have to ignore. I ignore the class because of this class. We can all see how important it is, because May diet is very short. We need to meet up with our target. And what is our target? Is to achieve 85%. I will dash you the remaining 15%. Why me? I will hold the 85% like this. You see the remaining 15%, I will dash you. I will tell you that go and read it. You see 85%, don't worry. Next gen will cover it. Right? So I think someone, okay, blessing quickly.
Okay, sir, please, what's the assignment again?
Okay. Check question 5. You've not done it. Check question 5. Check question 7. Question 5, question 7, and question 3. and question 3. Right, and question 3. Blessing, do you get that?
Yes, sir. Thank you, sir.
Welcome. Okikiola.
Yes, sir. My question is on the bond, the cost of bond, the interest. Can we also use the net tax interest?
You can
Like
use
we
it.
net the
Yeah, we can use it. I think someone asked that question in the first class or the second class. So you can use it, whichever approach you feel is convenient for you. There's nothing, but I think I gave that formula as well. Interest 1 minus tax rate. Do the net and move on. So whichever approach you want to use, just get what the examiner says you should do. Right.
okay, sir. The assignments we are submitting because I also do the question 5 and 12,
Okay,
but
no,
I joined the class late.
okay, you can share your suggested solution in the general group. Right. Let's see what you have.
Okay, sir.
Ibrahim, good evening, sir.
Ma.
Mr. Ibrahim, good evening, sir. Yes, thank you very much for the lecture. Please, network treat me off from the class. Please, I want to copy the solution.
Okay.
I got lost from a convertible value.
Okay. Ma. You may have to watch the.
Please don't refer me to YouTube, please. Please, I know. Please.
Okay, that's fine. That's fine. Okay. Okay, that's fine.
Let me copy from IRR. Try 2% like that.
Okay, that's fine. You can do that. I think he's there. You can, yeah.
Screenshot your screen.
Keep going up. I want to copy from try 2%.
Okay, like this. Is it okay like this?
Yes. Yes. Oh yeah. Go up again. Let me screenshot it. Okay. Thank you very much.
Hello, sir.
You're welcome. Yeah, I'm with you.
And good evening, sir. So why computing for our weighted average cost of capital, the convertible bond, is it not 6.9% of 160 million?
What's that?
The convertible bond.
The value of convertible.
Okay. Don't worry, sir. I've seen it, sir. I've seen it. Like I was getting 11 million and 40 million.
Tell that boy. Tell the boy to stop sending you that message, okay? After the class. After the class, you can continue. It may be sugar mom, sugar daddy, or you know. So, any other question, please? Okay. Okay. You can put down your hands, right? Any other question? So are we good? Okay, I think I have to go. In our next class, we'll look at the second part of cost of capital, which is project-specific cost of capital. Of course, the material may be available before the next class, which is Wednesday, right? I have to check some other questions that I have. I have fresh questions under what? Project-specific cost of capital. So in our next class, we'll look at all of these things. Remember that grace does not work in isolation. You have to work for it. You have to inconvenience yourself, right? You have to inconvenience yourself, and May diet is very, very short. Thank you once again for joining, and enjoy the rest of your evening. Bye.